What's up, everybody? It's your boy Deonte Burden, aka Mr. Short Dollar himself. Previously we had a video where we introduced different funding mechanisms for small businesses, that being debt financing, the other one being equity financing. And what we're going to do in this video today, we're going to talk about the different funding solutions, the different loan programs, the loan products that are there for small businesses. Before we get started, I want to reintroduce myself. I am Deonte Burden, aka Mr. Short Dollar himself. Mr. Short Dollar, we talk about personal finance, business, entrepreneurship, and investing. We have over 300 videos on the YouTube channel where we cover items from business operations, business management, business funding. We have a grants playlist where we have over 150 grants always listed on the channel. And listen, the easiest way to get all the information that we currently have and to stay updated on all the information that we have coming down the pipe, hit that dollar sign in the bottom right-hand corner. Now we get started. Okay. Move this on a little speed, I see. Here we go. We're going to talk about pretty much 7 different debt solution products, right? And what we're going to talk about, that being traditional term loans, SBA loans, business lines of credit, business credit cards, equipment financing, invoice financing, short-term loans. And pretty much what I'm gonna do, I'm gonna go all these different products for small businesses the short dollar way, so you'll know in English exactly what's going on, as opposed to, because I know a lot of times when people give out financial terms, it can be very confusing, especially if it's not your world or anything like that. The first one, traditional term loans. And we're talking about traditional term loan, borrowing from a lender and paying money back with interest. This is pretty much the most common loan product that everyone has, the traditional term loan. It's usually the easiest type of small business funding for anyone to get. And it's pretty much the same thing if a person is borrowing a particular amount of money and they have at a certain interest rate and they're required to pay it back at a certain time on a set amount. Okay, again, you borrow a certain amount of money at a particular interest rate over a certain amount of time or term, same thing, and you're paying a certain amount, a certain payment amount, okay? In essence, that's pretty much what we look at being a traditional term loan, okay? Generally, business term loans are going to be one of the most, the best small business funding options for owners of mature businesses who want to borrow money for a long period of time, i.e., more than 2 years, and want predictable monthly payment, okay? Like I said, again, this is pretty much set up. The way it works is that it's a amount that's borrowed over a certain fixed period of time at a fixed rate, at a fixed payment amount, okay? Very, very easy to understand in regards to what the loan is. The thing of it is, I think a lot of times people, when they bring up different loan products, people just aren't really familiar with it, but this is just your basic traditional term loan. Okay. Give you guys an example of this. Let's say somebody wants to borrow $25,000 worth of equipment. You want to purchase $25,000 equipment. You go to your bank and they say, hey, look, you qualify for this $25,000 loan at 12% interest rate, lasting 5 years, or 60 terms or 60 payments. That's what you'll be making, okay? They're looking at what you qualify for. Once that's set up, then they'll be generated how much your monthly payment will be. Going back what we just stated, that's pretty, lady. For $25,000 at 12% interest over 60 months, your term is looking at you paying $556. With traditional amortization period, the several initial payments will go or primarily go toward that. And what we mean by that is when you have an actual loan amortization table, or that means it's gradually decreasing with the payments, the initial payments over those first 60 months, majority of the money is going to go towards interest. As you get further into the loan, from the middle to the end, majority of those payments go towards decreasing the principal amount or the $25,000. Okay, but this is pretty much a most simplistic way we can explain the term loan, the traditional term loan, because again, it's a certain amount that's borrowed at a certain rate over a certain period of time, paying a fixed payment. Okay. Very much cut and dry, exactly what it is. Like I said, this is the most common that you can get. Again, go to you matter have a conversation with your lender, finding out exactly their terms and what they want you to qualify for. But this is the basic loan product that most banks will offer to you. Okay. The next one is SBA loans. Okay. I know there's been a lot with SBA loans the past couple of years because a lot of people getting the disaster products and the PPP loans. But this is your basic SBA loan. Okay. Okay. The Small Business Administration help entrepreneurs get funding for business needs in the form of long-term, low-cost business loans that are often the most desirable types of small business funding for business owners. The SBA is a federal agency, and what they do is kind of, in essence, I'm not familiar, you guys are with like VA loans. They don't necessarily give the loan out, but they have qualified SBA lenders that lend the money out. And what they'll tell the lender is, look, we've already vetted this person. They qualify under our standards. And again, even though the actual bank may do the vetting themselves, they will gather the information. But with those particular standards met, the SBA is saying that, hey, we will back this loan. If this person defaults on this loan, we will back this loan. So it makes it very attractive to the lender to say, hey, what do we got to lose? If this person defaults, the SBA is going to pay us the money back. On the flip side of that, the SBA, you have to meet the guidelines that the SBA and that bank has set for you to qualify for that particular loan, okay? Typically, guys, I'm going to be honest with you, this is probably the best product you can get because it's government backed. You're going to have the most favorable rates and use the most favorable term, and probably the most safest product to have in regards to borrowing anything. It's a very lengthy process getting an SBA loan. I'm gonna be very honest with you. Very tedious. A lot of information is required, but again, it's probably one of the best products you can get. One of the safest. Again, the banks will pretty much let you know in regards to what exactly the information they would have. I can just say it's our personal experience because I've acquired 2 SBA loans. This is all pre-COVID. So it was a lot more information that was required, in regards to what people need in regards to an idle loan or disaster loan. A lot more information that was required. It was a process that took probably maybe about 2 months, and mine might have been a little a little more expedited. So it is a long process, but again, long term, low interest product at a favorable rate is a great way to go. Okay, usually they require. I'm just thinking off the top of my head, one of the main requirements will require the individual guarantor to have a credit 700 credit score. And what I mean by guarantor, the actual loan still would be applied to a tax ID number for the business. But again, with most small businesses, this is a good nugget for you guys to understand. Even though the loan will go to the business under the business tax ID number, they will require some individual to be the personal guarantor in case it defaults. Okay, be honest with how it goes. At certain points, as your business credit established, banks may not require a personal guarantor, but I will almost guarantee you those initial loans, especially what I'm talking about. We're not talking about entry $1,000 loan, anything like that. Any kind of substantial loan. And to be honest with you, I can't even say even under 10,000, they might not necessarily want a personal guarantor. They're still going to want some individual being a personal guarantor. It would not be on your credit report. It will be listed with the business, but again, just to have some kind of guarantor, just in case the loan defaults from the particular business. Okay, and these are the 3 main products that the SBA programs offer. That being the 7 Alpha loan program, the micro loan program, and the 504 CDC loans. Pretty much, we look at the 7A program. That's just your basic loan that I was just talking about before. Based for debt financing, where you can get. I don't know if it's a cap on the actual amount, but that being the most common SBA programs that you can have, usually ask for the same thing in regards to the credit score of the guarantor, business projections, financials, debt schedules, things like that. But that's the most common product they use to start your business, debt refinancing, acquisition, things like that. Okay. The second product being a micro loans. These are usually small loans under $50,000. They're a little bit easier to get. Again, because they're coming to the SBA loans, they are more favorable, especially from a rate perspective, than if you go to, your bank by itself and get a certain product, even going some outside lenders. But micro loan is usually those loans that you need, maybe for a basic startup, a bridge loan, something to just carry you over a certain period of time. But those are the micro loan products. The next one being the 504 CDC loan. This is usually used when you're doing any kind of large fixed asset acquisition or purchase, any kind of big capital improvement, real estate purchase, thing like that. That is what the 504 CDC loan is for. Just so you getting your business set up, you want to buy a standalone building and one thing like that. That typically would, require you move you towards getting a 504 CDC loan. It is important to remember that for all of these loans, individual SBA approved lenders and banks will determine your eligibility. Like I just said before, we want to make sure that you have good credit, the company is profitable, have a compelling business plan with positive projections. Your company being profitable is not really a real biggie, because they will give you a loan just being a startup. But that credit, the actual good credit, so usually that'd be a minimum 700 credit score, and be very honest with you, because I've had more than one SBA loan. That's what they usually require. The financial projections, they have like a standard form that they'll have a spreadsheet that they'll give you to fill out. They want you to put in some realistic numbers though, in regards to what you're going to have, but they pretty much have everything set up as far as the financials and projections, the debt schedule and stuff. They have their own forms that you can use, so you don't necessarily have to go and get an outside CPA or an accountant or any financial person to draft those up for you. They usually have their forms, and you just have to fill them out accordingly. The basic SBA loan example. Start looking at, again, that 7 alpha, that mean loan. This is pretty much the same thing, just like a traditional small business loan. Same thing from a term basis. Usually a 10-year loan. I had got a 10-year, $150,000 loan, and they're looking at the maximum interest rate. They have that market rate plus prime, and I think I was around about 7%, something like that. And going to fluctuate a little bit because of the market prime rate does change. And this is like showing something for November 2019. Well, I was gathering data from at that particular time, but that's one of the things you kind of look at, and they have a list of SBA back lenders. But again, usually just a term loan set for that, and you can pick, and you can go back and forth. They'll usually choose it. If it's something that you can't handle, you can let them know in regards to the actual terms that they give you. But that's basically the 10-year, $100,000 loan. Prime plus the interest rate plus market rate, and that's typically it. And I think I was locked in something like maybe 5% and 2% plus the prime rate, and I kind of hover around that little 7% mark myself. So again, it's pretty cut and dry, just like a traditional loan, guys. And so it's nothing too difficult. It's just a little more. It's just a lot more from a acquiring standpoint, a little more difficult to get a hold of. Now we have business lines of credit. Business lines of credit. This is an awesome product. I kind of steer a lot of my clients to get to looking to getting business lines of credit, mainly because what it does, one of the biggest things theoretically, that the business line of credit, was the loan, you're borrowing money, the business line of credit, you're getting access to money. We're going to discuss that right now. Business line of credit is going to be one of the best small business funding options for businesses that have unpredictable or seasonal capital needs, and those that want flexibility to draw funding on an as needed basis. And what that means is that you, with a loan, you're borrowing $100,000 over a certain period of time, making payments. What you're doing with a business line of credit, you're getting access to a certain amount of money. So what I mean by that is, you can get a business line of credit for $100,000, but you might just need to purchase or get some repairs done for $10,000. What happens is, you spend the $10,000, you'll make payments on the $10,000. You still have $90,000 available to you. It's a great product they have, because sometimes when people get loans, it's great to get a loan if you need all that money at one time to take care of what you're taking care of. But if you get a $100,000 loan, and at that particular time you only need $30,000, $40,000, that's $60,000 you're paying interest on. that you may not have a purpose for at a particular point. The business line of credit alleviates that. It gives you access to that. So what you need, you pay for. And this is very, very helpful in regards to times when you just may have, they need to bridge certain things out, especially certain bills or credit cards or payroll expenses, things like that. Again, as we were talking about before, how it works. Again, you're getting access to the funding as opposed to you're borrowing the money in particular. Again, this was very pivotal. When I had a cleaning company about 15 years ago, that was one of the main ways that I covered my payroll. That, when I had the payroll going, I would, because the actual vendors, the customers that I had, when I billed them, I would typically get my invoices paid in like 45 days. But all the while, I still got people working. So I used a line of credit to cover my payroll. And then once the invoice was paid, that covered the amount of money that I had borrowed on the line of credit. And I just had my residual from there. So it was very, very crucial in me sustaining that business. Unfortunately for me, we had the market crash in 2008. And overnight, my $30,000 line of credit went to $5,000. That's a whole nother sad story. That's a Shaw brother right there. I like that. Okay, here's business line of credit example. Pretty much what we talked before. You qualify for a $60,000 line of credit. You withdraw $40,000 of business funding for a big expense that's available, and it takes the credit down to $20,000, right? Once you pay off the $40,000 you took out plus interest, your funds are back available to $60,000. Super easy to understand, okay? Super easy to understand. And I will, this is something that's very, I need a lot, especially with people in the transportation industry, because especially, you have a lot of truck drivers, people pay for a lot of repairs and stuff out of cash and whatnot. A lot of them have a lot of issues with staying afloat. But if you have something like this lines of credit, because we all know if you in the transportation industry, not if something breaks down, it's when something's going to break down. But if you have these things at your disposal, it'll be very pivotal to your organization being able to sustain. And what I will give you guys advice on, I recommend you have more than one line of credit. You have several of them. You just got to be disciplined. You having access to it doesn't mean you're using it. But the more, it's better to have and not need than need not have. I learned that in the military. One of my platoon sergeants told me that back when I was in Bamberg, Germany, and I've always lived by that rule. It's best to have and not need than need and not have. Okay, because when you really have an opportunity for capital expansions, you need to get certain repairs, things like that going, you do not want to be looking for money. If you already got it at your disposal, you need to use it. There you go right there. The next one we're going to talk about, business credit cards. Here we go. Many small business overlook business credit cards as a way to finance the business. However, using the credit card can be one of the easiest and most affordable business funding solutions. Ultimately, business credit cards can be used financial tool for business owner. However, compared to many of the other funding on list, credit cards may be the top funding option for business who don't need too much business capital and don't need access to a lot of cash. Pretty much how it works is you have a credit card, just typical like we were just talking about access with the business line of credit, a card that you can have, that's available to you. Same thing theoretically. If you need to make a purchase or acquisition, you use your card, make the payment, and you pay on the debt that you borrowed. So if you have a $5,000 credit card, you make a $3,000 purchase, you're going to pay payments plus interest on the $3,000 you borrowed, and you also at a particular time have $2,000 available. You pay that $3,000 back plus the interest, you'll get restored back to the original amount of the $5,000. Pretty simple example. Same thing we talk about here, and that interest rate can vary. The better your credit, use the lower your credit score. I mean the interest rate. I apologize. The better your credit score, better your credit rather. The lower your interest rate, and that'd be the cost of borrowing. You have some products that give you 0% over a certain thing, and that typically would be associated with somebody with better good credit. But again, rates can vary from different amounts in regards to that, 13, 14% on average. You have some to be astronomical, 25, 30%, depending on that borrower's credit rating. But again, it's just like the line of credit. You have access to a particular amount of money, and you can leverage that out. You have need to take care of something at a certain point in time, and you don't have cash available, or you don't want to spend your cash. You can do that because the money will be coming. Great product to have at your disposal. Equipment finance, next product. Equipment finance is the name implies is a type of business debt finance that is specific to purchasing equipment for a business. By applying the equipment financing is also called equipment loans. You have a quick, streamlined way to access funds to purchase computers, machinery, vehicles, or virtually any other type of equipment. It's best for equipment finance. Equipment finance is going to be one of the best small business fund options for businesses that need capital purchase or lease vehicle, computer, tractor, or specialized machinery equipment. Typically, when we use the example before with the transportation industry, people want to lease a truck. People in the construction industry, they don't want to buy certain equipment for a certain amount of time. They may actually lease out a certain backhoes, tractors, drilling equipment instead of using them at one time. It's very pivotal because a lot of companies they actually can acquire the jobs, but they may not be at that particular time to acquire the equipment and may not necessarily need the equipment because if it's a particular job that they can do that they don't do it frequently, it may be a little bit more cost effective just to rent out a particular equipment to drill a hole out, to fill a certain hole in, to actually break some certain things down. So this is equipment finance will pretty much give you opportunity to do that. How equipment financing works. An equipment loan is asset-based financing. Term loans, BLA loans, lines of credit depend more on your history and business financial. Equipment financial is more like a car loan since equipment itself acts as collateral and backs up the loan. The lender is more likely to approve it if you don't have stellar or credit financials. And like I said, the only thing that's saying is that the actual asset is used as collateral. So if you're buying that particular truck, or if you're buying that particular piece of equipment, what is known is that if you can't keep up the payments, they will repossess it, take it back, things like that. Equipment finance, it also can be financed in two ways. Here's the thing about it. You can do it like we talked before with the purchase, like when you make the purchase on the particular item and you make a payment toward it, and that particular item is used as collateral, or you can be done what's called a lease. And a lease is where you're renting it in the essence, and you have certain standards that you have to make sure that you're keeping it under while you're renting it. Okay. So again, you can be purchasing it to own the equipment, or you can be leasing the actual equipment out. Okay. Two different finance mechanisms that you can use with equipment financing. Equipment finance example. Let's say as an example, you're looking for business funding to purchase a vehicle that's worth $30,000. You get a 2-year lease at a 20% interest rate, and you pay $1,500 a month. Alternatively, you might get a 5-year equipment loan with a 10% interest rate and just pay $550 a month. Excuse me. In either case, you think equipment finance might be a worthwhile funding option. You might consider exploring other leases like Balboa Capital. And again, I don't want to. I just put that on there as one of them because I was trying to do some research on it. But you can do a quick Google search in regards to who you want to use for that if you're looking to use a particular product. But just take a look at it for a second. You see that you can get a lease for 20% rate and pay $1,500 a month, right, for 2 years. And the reason why, theoretically is more because the term is shorter. You're going from 2 years, you just rent it out for 2 years as opposed to holding that assets for 5 years, even though you're paying to own it. That's why the payment amount is lower. Plus you have a lower interest rate, okay? So just kind of look at that. These are kind of things. It's not a matter of what's best or worst. It's really what you need at that particular time for your situation, right? Okay, so just keep that in mind. The next one is called invoice financing. Okay, a very specific type of debt financing. You might use invoice financing if delayed payments from clients are seriously endangering cash flow. Invoice financing is another asset-based funding option where business receive cash from a lender that is collateralized by your accounts receivable. It's best for is going to be one of the best small business fund options for business to business companies that have money tied up in unpaid invoices. Another name for invoice finance is also called factoring loans. Pretty much somebody just giving you money in regards to fronting you the money or giving it to you up front based on your receivables. So we want to look at how does invoice finance work. Essentially, invoice finance, also known as accounts receivable finance, like I said, or we can say a factoring loan, is a form of business funding through which lending companies advance your accounts receivable through a quick cash advance of about 85% of the value of invoices. Later, when your client pays the invoice, you'll receive most of the additional 15% minus fees. Invoice financing companies charge a small weekly percentage on the amount of the invoice. If the company relies on customer paying their invoices, then you've probably encountered the problem before. A late payment from a customer could seriously impact your cash flow. With invoice financing, you're basically paying a small fee to get your invoices paid immediately instead of some undetermined time down the road. Depending on how your business's cash flow works, it might be well worth the cost. Plus, another benefit of invoice finance is that the provider won't check your credit. Instead, they care more about your customer's repayment behaviors. A couple things we want to kind of note about this. Typically, with invoice financing, they want to make sure that you're actually guaranteed of making a certain amount of money a month before they start looking at giving you the option of financing or giving you front or give you the money up front. What do they look at with that? Typically, just say they may be more comfortable with a contract, especially from a solid company or established company, a government entity giving you a contract. They're more comfortable to give you that because they know it's almost guaranteed that this company is solid or established, or this government entity is going to pay your money. That may not be the same thing. You know what they say, weekly amount with that. It may vary in regards to that as far as the percentage is taken out, but it is something that they're going to look at in regards to the actual credibility of the actual person that's doing that, the credibility and the dollar amount that you're usually getting in, the credibility of the person that's paying you and the actual dollar amount. Again, so if you're just if you don't necessarily have a contract, you have to show some sustained amount over a certain period of time. So they may go and look at your bank statement or financials for the previous 3 to 6 months to just substantiate, okay, they are receiving this particular money that we can award them up front, okay? Invoice financing example. Let's say you have $5,000 invoice that's due in 8 weeks, but you need the money right now. And then we'll finance the company front you 85% of that invoice, $4,250 immediately. They might charge you a fee of 1% each week that the invoice goes unpaid. That's $50 a week. If the customer pays you back in full 8 weeks, that's $400 in fees. Your pocket $4,600 out of the $5,000 original invoice. And here's the thing I want to tell people too. This is a common product, especially you got a cleaning company. Funeral homes use this too because the lag in time between they get the insurance policy when it's paid out. A lot of service companies use this because, again, when they send in those invoices out, there is a lag in regards to in the terms of when they'll be able to get their money back, but they still have bills to pay in that particular time. So it's nothing uncommon for them to do that, to use that. Short-term loans. Generally, the more quickly you need finance, the more you'll have to pay. That being said, short-term loans offer a happy medium between affordable and quick. They're best for you when people that need quick funding. They can't wait for other, and for other types of low-cost financing, generally associated with how short-term financing work, short-term loans rather. Usually you can get access, to these products. The only thing about it is that you're going to usually, because it's shorter, it's a short-term loan, you can get access to it quick. It's usually going to be a much higher cost. Okay, the accessibility to getting it, these loans you may be get for maybe a year, 6 months to a year. They can get it. You may even sometimes have some credit challenge to get it, but the cost is going to be a lot more because it's not spread over a certain amount of time. So that's just something to keep in mind when we're looking at short-term loans. We're trying to acquire them and everything. how they work rather. An example of a short-term loan, say you take $100,000 of a small business funding in the form of a short-term loan, and you pay back 6% of an interest rate of 20%. So like I said, a much higher rate. You'll pay this loan back plus interest with weekly payments. It can be weekly. It can be bi-monthly. I'm getting ahead of myself. I'm sorry. But the terms will be on the shorter man. The cost will be much higher. But again, this is one of the things where you need just quick to fund. You need access to it right quick. You can go to a company, say, hey, listen, I just need to get access to it. I can pay you back in around 60 to 90 days, maybe 6 months at most. And these usually loans that are under a year, okay? Again, they'll be accessible to you, but it's going to be a much, much higher cost. And again, I want to tell you guys, thank you. And again, I'm Deonte Burden, aka Mr. Short Dollar himself. Make sure you go to the YouTube channel, Mr. Short Dollar, where we talk about personal finance, entrepreneurship, real estate, and business, real estate and investing in business. We have, again, over 300 videos on the YouTube channel. We have a grants playlist. We have over 150 grants going live all the time. Guys, I really want you, I hope you guys enjoy the information we gave you. We broke down the different business loan products that are out there. There are other business loan products, and we'll make more videos to introduce you to them. But that's just a basic one-on-one so you can get an idea of the different products out there, because I meet clients all the time where they're not, versed with what a line of credit is, what is invoice factoring or receivable lending. What's a 504 CDC loan? What is it for? What is it used for? Where do I get it from? That's why I'm going to make this video to help you guys out with this information. Okay, subscribe to the YouTube channel, hit that dollar sign in the bottom right hand corner. I hope you enjoyed the information we gave you guys. Take care of yourself and be safe.